Hello. Today we're going to be looking at property, plant, and equipment, which also includes intangible assets. And we're going to be thinking about purchase and disposal of this property, plant, and equipment. Let's think about the common types of property, plant, and equipment. We have buildings, we have land, we have a variety of types of equipment, and this can mean anything from vehicles to computers to machines. We have natural resources, things like oil, coal, that kind of thing, iron ore. Also a variety of intangibles, including things like patents, trademarks. In some instances we can have goodwill, software. So all of these things are considered property, plant, and equipment. The controversy in the chapter is what we mean when we use the term capitalize. And this is something we have to be very careful with. What does the term capitalize mean? This is important. Debiting an asset that will help or will benefit the future doesn't reduce net income. And indeed, this is what we're talking about when we say capitalizing. However, debiting an expense does. So every time we do a transaction, every time we incur a charge related to an asset, we have to think, is this going to benefit a future period or is it not? Just a reminder here, that capitalizing is debiting an asset. So keep in mind, this is common sense, but if the debit is asset, that's not revenue and it's not expense. But if the debit were expense, it would reduce net income. In 2002, a company called WorldCom, which was a very large telephone company at the time, was exposed for committing fraud. And the fraud they did then was handled a number of routine expenses as assets. So if you think about it, where they should have debited expense and reduced their net income, they debited asset and it didn't show income going down. Now if you think about this, with the exception of land, every other type of asset will be expensed to depreciation expense. But the issue is, instead of having one large expense this year, we have much smaller expenses over several years. And sometimes this just isn't right. Obviously, in the WorldCom case, this caused fake or artificial net income. So one of the types of things a business owner could do is ask a question, well, I repaired my vehicle, which of course we said it earlier is a type of equipment. Should this be capitalized? Well, as so often in accounting, it depends. What it depends on is if something about the repair increased the value or life of the vehicle. For example, if you added a $2,000 stereo and this increases the value of the car by $2,000, so it wouldn't be replacing a stereo. Wouldn't be replacing one $2,000 stereo with another. It would be if you had just the manufacturer stereo in there and you upgraded. You could probably make a case that the stereo could be capitalized. On the other hand, if your car came with a starter and you put a new one in there, that's an expense. It's a repair expense. Here's a list of common costs that we capitalize. First of all, the purchase price of an asset. Any transportation charges that we pay to get the asset into use. This could be, the transportation of a machine to us, could be sending us a computer in the mail, that kind of thing. Any taxes on the purchase are also part of the asset, and they're what we call capitalized. Installation costs are capitalized. Testing the new asset and doing trials, these are capitalized. Attorney fees. Often you'll see this in connection with land or title fees. These will be included in capitalized cost. Exploration costs. This might be for cases of the some of the natural resources we talked about. And development costs can sometimes be capitalized, and we'll talk about that a little bit later. Well, at this point in the discussion, we've spent some time on capitalizing things. Let's turn and think about how we would handle disposals. And a disposal to me occurs in two ways. There's a third, which we'll call exchange and focus on in a minute. But for now, the two that we first think about are just throwing it away, disposing of an asset in the trash can. It's just worthless. Of course, a big machine probably couldn't just be put in the trash can, but you get the point that we could just be getting rid of it because it has no value and it doesn't work. So notice that one of the things we have to do is reduce the machinery account for the whole cost of the machine, the $30,000 that we paid for it. However, we also have to reduce with a debit any accumulated depreciation that we've taken on the machine. So you'll notice if we're taking $30,000 away from machinery as a credit and $20,000 as accumulated depreciation on the machine, this machine wasn't fully depreciated at the time we threw it away. Since it wasn't, the remaining debit is a $10,000 loss on disposal. Let's think about the same machine, except in case 2, let's figure that we sell it. So here we get $5,000 of cash with the machine. We again remove the accumulated depreciation just like before. We also remove the machine itself. However, because we got the cash, we only have a $5,000 loss on disposal. Now I want to caution you here that this is only a book loss. We do not have enough information at this point to determine whether this is an actual financial loss or not. It's a loss on our books, and this is proper accounting. However, if we got a blue book and the value of the machine was 0 and we sold it for $5,000, who could say we didn't come out ahead? Notice then that the loss really occurs in each case because we didn't fully depreciate the machine. If we fully depreciated it, then there would be no loss. A third example of a disposal is an exchange. And one of the questions we have to ask when we're thinking about exchanges is, does the exchange have commercial substance? In other words, will future cash flows change as a result of this exchange? So I've given you 2 examples where we're exchanging one piece of land for another. In the first one, there is commercial substance. We've exchanged one parcel of land that's going to result in future cash flows. Perhaps, for example, the old land was a closed factory and the new one is going to be a new factory that will be operating now. Notice that's different from we had one operating factory and we closed that and we're opening a new one. You could argue that commercial substance is harder to prove in that case. But in the case where we've really had a factory just sitting around idling for a while, maybe we've operated 3 factories and for a long time this 4th one just sat there, and now finally we're going to exchange it for another factory that'll operate. Well, here you could say this has commercial substance. So if it does, we're going to debit the new land for its fair market value of $2,500,000. We're going to credit the old land. Remember, land's not depreciated, so we don't have a debit for accumulated depreciation there. In fact, the second debit, as you can see, doesn't turn out to be for anything. We also got cash in the transaction of $500,000. I'm sorry, we paid cash of $500,000 for the land. In addition to our old land, we paid $500,000 of cash. And this turned out to be, we gave up cash of $500,000. We gave up land of $1,700,000, but we got land of $2.5 million. Therefore, we have a gain of $300,000. And we're allowed to show that because the transaction has commercial substance. But now, same set of facts that I just described to you. We exchanged one working factory for another working factory. Might be hard to prove that this transaction really has commercial substance. So we show the old land coming off the books at $1.7 million. We also show the cash that we paid, $500,000. And then if the transaction lacks commercial substance, we can't show the new land at fair market value. Instead, we show it at land, our old land plus cash. Now you might wonder why we do this. Is this legitimate? Well, the problem is we don't trust companies to just get fair market values from their real estate agents or appraisers. Sometimes these things could be false or fraudulent. So instead, if the transaction lacks commercial substance, we're just saying we're not going to allow the company to book a gain. We wouldn't want to see them show income that might not be real. And a gain obviously would be added to net income. A final word about self-constructed assets. At the top of this last slide, we have a number of costs that are typically capitalized with self-constructed assets. First of all, overhead. You've seen that in the management accounting class. But if the company constructed assets for itself and constructed inventory, then all the overhead that it applies, it would apply to both. And the overhead that's applied to the self-constructed asset would actually be capitalized. Any interest that we're paying to borrow money during the construction, like if we're using the money in the construction phase, we're buying something, then we're allowed to record interest to borrow that money. The cost of any materials and direct labor, of course, are capitalized costs. Software development costs can be capitalized for a bona fide software company after they determine that their product is going to be technically feasible. So examples of costs that have to be expensed. Research and development costs are always expensed for financial accounting purposes. Startup costs for new companies are expensed. Software development before feasibility is established, before technical feasibility is established, this cost is expense. And then once technological feasibility is established, then the software company can start capitalizing the cost. Well, this is a good overview of some of the issues in property, plant, and equipment acquisition and disposal. Let me know if you have questions.